Hey guys, Randy Patrick here, another video, Housing Bubble 2.0. We're in it, it's happening, I don't care what anybody else says, this is what's going on right now. Anyway, today it's ending the week of September the 22nd. Want to talk about a few things, and today we're going to go over housing price reduction and inventory. The HELOC ATM machine is back in play. Appreciation is highest where it's riskiest, and disaster impact on mortgage defaults. So here we go. So obviously in the news constantly now is price reductions in inventory. So on the heels of kind of a weak July, housing numbers were disappointing for August, according to some of the people that want to see the numbers to be a lot higher, of course. Existing home sales are the lowest point in over 30 months. That's pretty interesting. Also, inventories rose for the first time in about 3 years. And that was about 2.7% year over year. Not a huge number, but again, based on where the market was going and how the market was playing out, this is somewhat significant for what's happening. And according to Redfin, more than 1/4, so that's more than 25% of the homes listed for sale had a price decrease across the board. That's huge. That's the highest level since they started tracking this back in 2010. So we're looking at, that's 25% of all the homes listed for sale had a price decrease in the past month. That's pretty awesome. New York City home sellers are slashing prices like it's back in the day, 2008, 2009. And according to Bloomberg, the week through September 9th, almost 800 listings had a price decrease over a 1-week period of time in the month. And this is the largest wave of reductions or discounts in the past 12 years for New York City. And this area, of course, incorporated Manhattan, Queens, and of course, Brooklyn. Now, the thought process is people and buyers just aren't going to overpay developers, and the days of foreign money coming in and buying and having to keep up with that are over. I mean, a lot of stuff is being pulled out of New York. There's a lot of overbuilding. There's a lot of saturation now in the marketplace and a lot of inventory coming in the market. So that's what you got in the big New York City area. In California, the number of active listings were approximately 17% higher this August than the previous August, so last year in 2017. So we got 17% higher in the previous year. And of course, many other locations across the country where the market is cooling saw price reductions and, obviously market increase on listings, etc. So I don't want to, name them all. There's quite a bit, but just realize that, everything starts with the mega cities, the big metros across the country. When when inventory increases and prices decrease, it typically is a telling sign that this will eventually filter down to other locations across the country. Now, moving on to HELOCs. Okay, so HELOCs, home equity line of credit, ATM, which is automated teller machine. Well, recent study by Bankrate.com found that about 24 million Americans believe that using your home as a source of cash to pay for monthly bills is just to get by is a perfectly acceptable and okay thing to do. And now the thought of this is somewhat terrifying because if you're just using that money and burning the cash, the thought of paying that back, there really is no potential payback. Why? Because a home equity line of credit was really designed, and the thought process is you're taking the money out of your home to make improvements to the property, which in turn will result in more equity and appreciation when you go to sell it. So if no home improvements are being done and money's just being pulled out, let alone just to live and pay bills, we've got a significant problem with our economy and with what's going to happen to that homeowner in the future when things change. So this tells us, of course, that and we already know this. It's not a surprise. We're based on the total debt value we got going on here. More people are living paycheck to paycheck and scraping by, and this will be problematic for the future. Back in the day, last housing crisis, a lot of people did this. They did cash out refis and they did home equity lines of credit. They took money out they couldn't pay back, and then they became underwater mortgage candidates quite quickly once the housing market shifted price. So there you go. So again, taking equity out of your home is a gamble. It's a future gamble, and you're basing it on that future appreciation, i.e. will the market keep going up? The money I take out, I'm gonna make back or break even because everything's going up 10% per year, so I'll be just fine. Well, that's a nice way to kind of rationalize it in your own mind, but we know that doesn't happen, or that can change very quickly. So there you go. And again, after many, many years of quantitative easing, which is designed to stimulate the market. The Fed is expected to hike rates 2 more times in 2018 and at least 2 more times in 2019. So obviously the increase in market rates, interest rates have already contributed to higher borrowing costs, which has put more property out of reach for many would-be home buyers. So as we said before, how does the government plan on encouraging more buyers to come in the market? Well, they're trying to negate these high interest rates with lower down payment loans. So obviously we've got Freddie Mac and Fannie Mae pushing 3% down loans and increasing debt to income ratios for borrowers. So, if we were paying higher rates, then we'll offset it another way. But in the end, less down, if you're putting 3% down with higher rates and a higher debt to income ratio, a 5% shift in market value has you underwater. So it's not a smart move, and this may cause, or this will cause, more problems for us as we go forward. Again, over and over, we've discussed this. You've heard this over the years. Student loan debt is about $1.5 trillion now, which affects roughly 44 million Americans. This is the #1 deterrent from purchasing a house. Millennials apparently are shouldering the most amount of this debt, with 57% of millennials still paying for their education. This demographic a few years ago was touted as being the savior of the housing industry, this demographic that has a huge buying power and just volume of people in the demographic. Well, it's not been the savior of the housing industry, and it's actually quite the opposite. A lot of the millennial generation, as stated, will not purchase homes until their student debt is taken care of. And a lot of people in that generation do not value home ownership the way other people did previously. So again, that's not, the millennials are not the savior of our industry. We have other issues that are going on that need fixing, and it's not going to be through millennials. But funny enough, though, mortgage applications rose 1.6% this past week as rates hit a 7-year high. And why is that, people are asking? Well, it's that FOMO, fear of missing out. It's fear of, hey, if the Fed is going to raise these rates, 3 or 4 more times in the future, I want to buy a house, maybe I better jump in now and at least get my rate locked in when I purchase, because it could be, 1 or 2 points higher next year, and that's going to hurt me even more, or drill down my buying power, things like that. So again, and of course the refinance volume has led the charge. Out of those refinances, how many are cash outs, I don't know, but realize that people, if they know it's going to happen over the next course of the next 6 months or year, further increases, you better jump in now and lock your rate in so you're not paying too much in the future. So funny enough, appreciation, we found out, is greatest where it is the most riskiest to own a home. So per Atom Data Solutions, median home prices in cities with higher natural hazard housing risk have appreciated 40% on average over the past 10 years, which is pretty good return as compared to only 24%, which is the overall U.S. housing market. So if you live in a riskier location, I'm going to say things like waterfront or coastal or other locations that are interesting or just have draw for value. You're in the higher, riskier locations, but in the end, you're earning more, you're appreciating more in your home. So there's obviously not much of a trade-off there. So in theory, you're buying today, you're paying a premium to live in locations where in the end it still could cost you more money through insurance or other items if there's a future natural disaster event. How they rate or rank national disasters are as follows. There's 6 of them: earthquake, floods, hail, hurricane, storm surge, tornadoes, and wildfires. So obviously we all know that various locations across the country are subjected to earthquakes and flooding and hurricane, storm surge, and wildfires. So I mean, we know that's been happening, and we've seen over the past few years the number of natural disasters has increased, or at least through this last cycle of weather have hit the country a lot harder than the past few years. I mean, I remember back 10 plus years ago, we're talking 2004, 5, and 6. Down here in Florida, we had a number of hurricanes that came through in 2004 and 5 and 6. Then it was quiet for a good 10 years, and it sort of picked up its pace again. So I think natural disasters and weather patterns go through their own cycles as well too, which leads us to defaults and disasters. So obviously now we're realizing much of the aftermath of the storms and hurricanes that happened the past year, and most recently with Florence in North Carolina and South Carolina. Obviously, they've experienced a ton of flooding, and that's just because the storm kind of halted and slowed down right above the coast there and dumped 25, 30 plus inches of rain in a very short period of time. So lots and lots of flooding, which is very unfortunate for those people. But only a small number of the affected area of flooding actually had flood insurance on their properties, which caused another problem. And this is the same thing that occurred with Hurricane Harvey as well too. So one of the things with storms, it's you don't know how they're coming, how they're going to hit, what they do when they hit landfall. So if they're lingering, they're adding more and more rain. A lot of the locations just weren't equipped to handle the water. They could be low lying, or they haven't had storms or flooding in the past 100 years or so, so there's no adjustment to the FEMA flood maps and things like that. So again, this happened with Hurricane Harvey last year, and it happened again with Hurricane Florence this year. So lots going on. I think I was reading someplace maybe 3 to 4 or 5% of all the affected areas actually had flood insurance, which is not a good thing. So here's what will happen. Here is also what has happened over the past year. So lenders will give people the opportunity to go into what's called forbearance. So you can contact your lender and say, hey, we've had a situation, we're not going to be able to pay our mortgages for a certain period of time. Could be 3 months, could be 6 months, and they will do that happily for you, and the forbearance will not affect your monthly credit. So you've basically taken a timeout from paying your mortgage. Those non-payments don't affect your credit report, which is kind of nice. However, once that 3 months, 6 months, whatever you've negotiated, sometimes the government might even extend that for certain locations. You're expected to have the money to pay and bring that mortgage current. So of course, once that happens, the majority of people can't bring it current because consequently what has happened? Well, they've been out of their house due to flooding or other issues, and guess what? Their places of business may have been in the same situation. They're expending more money, they've lost income, not getting paid from work. It's a very huge domino effect. So guess what? The forbearance period runs out. Most people can't afford to bring their mortgage current from 3 or 6 months or even more down. So they go into the situation where they have to look at other alternatives, loan modifications. I don't know what else they can possibly do, but they could go into default and eventually have foreclosures filed against them, which is what's been going on in some of the locations, Houston, South Florida, things like that, Puerto Rico. So additionally, what happens with disasters, it puts strains on the local housing market from two perspectives. Okay, for example, in the North Carolina, South Carolina area, there's not much available in rental options. So you don't have that many homes that are sitting there vacant for rent or many multi-areas for rent. So all these people who are displaced have places they have to go, which puts a strain on the local housing economy, which can result in possibly higher rental rates, more issues, etc. So only time will tell how this plays out for these local locations. Now, Houston, I know, has many, many defaults because we've gone through a full year now from Houston. And there are some issues going there right now. We're talking tens of thousands, if not even over 100,000 defaults in that area. South Florida, same thing, many areas with the blue tarps, a lot of defaults going on as well too. Puerto Rico is an entirely other story. Puerto Rico already had double-digit defaults prior to the storm for other economic reasons in that location. Was going towards the world of bankruptcy as a whatever you call it, it's a territory, and then the hurricane hit, which will cause more and more problems. So just realize that these are some of the issues that will occur with natural disasters. And again, this is just kind of the East Coast here. So obviously Houston is being in sort of central, but I'm not even talking about wildfires that happen over in California, and eventually mudslides or things like that can occur, all the fallout. And again, wildfires, a lot of times homes are just disappeared, like they're gone. They need to be fully rebuilt and things like that. So, again, stressing that economy and that housing market as well too. So a lot of things happen. So the interesting thing about, again, natural disasters, as I said, it stresses the most immediate local housing market to find locations and places where people can live and rebuild. And then from the flip side, as time goes on, when they're dealing with the damage of their home, if they're underinsured or not insured, they can't afford to fix it. The damage is going to outstrip what they're going to get from the insurance companies that they're going to default, and that home becomes a future foreclosure, and then it becomes a devalue on the housing market, which then it brings up another opportunity for investors to purchase and rehab and resell the home. So it's a kind of a scenario that goes on. There's disaster, there's sadness, there's damage and issues, and then there's rebuild, hope, and opportunity. So it's a kind of a cycle that happens with natural disasters. So again, realize though, but in that area up in the South Carolina, North Carolina area, we're going to see devaluation and rebuilding, and just people having a hard time. That's the way it goes. Again, disasters do mess with the housing market. It does add to the overall defaults, and it causes problems for us in the future. So we'll see how that all plays out. So anyway, it's a shorter, not too much, I mean, I guess you could say not too much going on, but enough going on. Again, the main discussion points are we're seeing more inventory hitting the market. We're seeing more housing price reductions, which is good, which should alleviate some strain. But it's not fast enough, though. We still have to get more inventory in the market. We still have to get more price reductions so buyers have ability to have more choice and things come back down to earth. So, are we in a housing bubble? We are. We hit the peak kind of, June, July, August area. I think that, as I said, as the months go on now, we're going to be able to track and see the slide of depreciation or devaluing going on. Everything that we talk about or we see in the media is year over year. So even though August was a flat month, it still posted a year over year increase in value through sales, because that's just the nature of the ball game. But when we're looking at month over month, we're seeing declines in value and things like that, and of course increases month on month on inventory coming on. So that's going to play out over the course of the next couple of months. And again, it's what do you do in this market? If you have homes, do you sell homes? Do you buy now? Do you wait to buy? If you're investing, do you invest now? I'm at the top of the market. What do I invest in? Do I wait for more short sales and foreclosures to come on? So a lot of questions going on. We're right at that transition time right now. This is where it's sort of difficult, is that people will tell you that we still will have strong housing in the future. Well, I really think it can't go much higher. Some metros may have some increases still, but I think as time goes on, we've plateaued, where we will have to see sliding of values, and then we will have to see some, I guess, fallout from people buying with higher interest rates, with low down payments and high debt to income ratios at the peak of the market. That doesn't bode well for the future, and we have seen from back 10 plus years ago what happens when things like that occur. Anyway, again, appreciate the views, appreciate the comments, appreciate the subscriptions, and good luck to everybody, and we'll look forward to speaking with you about this time next week. Thank you.